Buy these stocks. Buy these stocks in the month of August. Buy them. Everybody was like, the stock market is going to crash. Oh, is this the time? Why are you concerned about whether the stock market is going to crash? Build your portfolio in such a way that even if in the event of a market sell-off, you are still protected. Have stop losses. Don't just leave your stocks running. Take gains along the way. Your stock is 50% up, 100% up, 200, 300, I mean 1000%, and you didn't sell, you didn't don't be greedy, and you didn't take profit. Don't do that. You make double your money, take profit. You make 200%, 400%, take profit. Don't just leave it there. Okay, so that you don't just you don't cry me a river right here. So let's look at the AI infrastructure trade. Look at some names that you would love to have in your portfolio. So this is the single most important slide for this conversation. The S&P 500 gained roughly 8% through the first half of 2026 and set an all-time high above 7,600 in early June, which was driven largely by AI and infrastructure spending. Then July happened. $750 billion was committed to AI initiatives by companies in 2026. Uh, then we have Google raised their capital expenditure from 195 billion to 205 billion. Amazon planned to spend around $200 billion. So this is 5% of the last 20 August finished higher as well. So demand for AI compute is not in the question. Companies have committed more than $750 billion. So what changed in July is what the market is willing to pay for the demand. So when Alphabet raised its capex number, investors did not read it as bullish. They read it as a bigger bill with no clearer return date. Alphabet dropped 15%, Meta about 10%. They both grew revenue, but Wall Street doesn't buy that. So the bull case is here that the derating is sentiment, is not fundamental based. Always stick to the fundamentals. The bear reading is that the market is starting to price capital intensity, speculations. Everybody's going to speculate. So one thing to note in August is the 65% historical hit rate with an average gain of roughly 0.3%. So this is a weak hedge, it's not a strategy. So just continue to pay attention to those stocks as they unfold. So let's look at some stocks here that you might want to have on your radar. Number one is Nvidia. Nvidia is the most profitable company on the planet. It's the anchor position for many AI plays. It captures value from build out without carrying the build out balance sheet risk. The strongest single data point is the acceleration. Q4 FY26 revenue was $68 billion, which was up 73%. The following quarter was $81.6 billion, which was up 85%. Cycles that are peaking do not accelerate. Gross margin was nearing 75% at that time. So that means Nvidia is not buying growth with price. The 95.2 billion dollars in supply commitments, which is up 50 up from $50.3 billion, is management putting capital behind its own forecast. So now let's be honest about the risk, because it is the most interesting one in this conversation. Nvidia holds equity in CoreWeave, Nebius, Iron. They also signed a $3.4 billion cloud contract with Iron. So Nvidia is investing in companies that then buy Nvidia chips. Uh, that might be cyclical, like many investors have been saying, but it's the most profitable business on earth. What do you think? Buy Nvidia. Buy Nvidia. Make sure you have Nvidia in your portfolio. Then there's AMD. AMD. AMD reports Q2 2026, and they're gonna. So that's their earnings is tomorrow, August 4th. So let's see what AMD is gonna bring to the table. AMD enters earnings with roughly 120. It is raising 122% year to date, with consensus at about they think they could have $1.61 earnings per share on an $11 billion revenue. So the investors are going to be seeing if they are going to be able to hit that threshold. So AMD is also pivotal to the chip development, growth and development. So you want to keep an eye on this tomorrow. Lisa Su has claimed Helios delivers 15% better compute than Vera Rubin. There's this healthy rivalry between Nvidia and AMD, but well, who cares about that? As long as they're making money and the shares are going up, we are good to go. Meta is another stock you want to keep on your radar. Meta is the clearest illustration of the whole central tension. The business had a good quarter, grew 28%. They had 14% impressions. Price per ad rose 12%, but they still missed earnings. It came largely from $3.58 billion in legal and severance charges tied to a workforce reduction of about 8,000 people. And then there's a higher tax rate. So all of this really affected them and they crashed. But Meta is planning on investing in data centers. They have a lot of compute capacity. They're trying to convert them to AI solutions. So be on the lookout. Meta is poised to go $800 very soon. I don't know what day, but with the rate they are going to hit that $800 threshold. They came from $700 to where they are right now. So the potential for growth is always there. Then there's Oracle. Oracle has really gone down. Really gone down. Oracle is where the reward and the risk are both largest, and where the audience most needs precision rather than enthusiasm. The bull case is real and unusual. Oracle's market value has fallen below the size of its own contracted order book. So that is a strange thing to see in a profitable company. The RPO of $638 billion against $7.4 billion of annual revenue. They have cloud infrastructure going at 3%. They have a PE ratio which is near 19.7 versus year average, 5-year average of around 34. So the stock is down more than 60% from the September 2025 $345.72 peak. Free cash flow was negative $23 billion in 2026 fiscal year. S&P cut credit rating to BBB. So just like, oh guys, you're just spending money, you don't know where you are putting your money. And S&P 500 named OpenAI as a credit risk with respect to not S&P 500, S&P. So they said, okay, Oracle's investment in OpenAI is credit risk. So they have a debt of around $130 billion against $43 billion of equity. So that's a debt to equity ratio of nearly 300%. That's scary, but these guys know how to do the business. So you won't be surprised if their market cap shifts base upwards from here. Oracle is not a discounted blue chip. It is a leveraged, concentrated bet on one counterparty's ability to fund its commitments. So that can still be a good bet, but it should be sized like that, like the bet it is, not like a value stock. If someone wants exposure to AI theme without financing risk, Corning is a structural answer in this group. Corning is into wearables, glassware, fiberglass. If you compare Corning with Oracle, I mean, spending is $55.7 billion, generating negative cash flow of $23.7 billion for Oracle. Now compare that with Corning. Corning has free cash flow of $1.4 billion in the current quarter against roughly $2 billion of planned annual capital expenditure. So the technical detail uh, on the third optical layer is the most interesting part of the thesis and worth explaining. So as GPU clusters grow past roughly 130,000 units, the network architecture requires an additional optical layer. Corning's content per data center therefore rises faster than GPU count. So management has said the enterprise segment can grow faster than GPU growth rate. This is a real structural advantage, not a narrative one. Corning is very cheap to buy right now. It's at $140, $150, $155. It rose up to $270. So is about to bounce off again. So if you are interested, if this is something you want to invest in for long term, begin to consider Corning. I got Corning at $87, rose to $270. So that was a good bargain. Yeah. So we're riding it again. Rinse and repeat. It's rinse and repeat time. Then there's Nebius, very volatile. Very volatile. Nebius is very volatile. Best understood as a deliberate counterposition to CoreWeave. The July sell-off drew a clear dividing line. It's capital intensive, debt and dilution heavy, balance sheet owned models were punished. Nebius assets light pivot is a direct response to exactly what the critics are saying. Yeah, whether it works, well, if you need something that can run exponentially and you can make some change over that, yeah, you might want to consider Nebius for the next 30 days. Once you hit a 50%, 80%, 100% mark, just sell. This is not something I want to keep for a long term because of the volatility.